Hello and welcome to Impact Tuition. We are dedicated to helping students prepare for the ICA exams. Today we begin our discussion of the financial reporting syllabus. Last week we did an overview of the entire syllabus. If you haven't watched the video, kindly do to help you have an understanding of the whole financial reporting syllabus and what is expected of you. Today our discussion will be on the regulatory, legal, and ethical framework and the IASB conceptual framework for financial reporting. It will be a two-part series. So the whole first section of the syllabus will be divided into two. We'll first deal with the regulatory framework, which is what I will do today, and then we would later deal with the conceptual framework. Before we begin, kindly like, subscribe, and share. Alright, let's begin our work for today. Today we are dealing with the regulatory framework. So let's look at an overview of what we'll be looking at today. We'll first talk about the need for regulation. Then we'll look at the IFRS Foundation and the IASB. We'll also talk about global harmonization of accounting standards. Harmonization of accounting standards. Financial reporting and corporate governance. And then we'll end with the IFAC Code of Ethics. So this is our task for today. Let's begin. The need for regulation. Why must financial reporting be regulated in the first place? The first obvious need for regulation is that it ensures external users are provided with information that is relevant to their decisions and are reliable. Financial reports are prepared by the entity for external users. So the regulation comes in to ensure that external users are provided with information that is relevant. So our first point is ensures external users are provided with relevant and reliable information. That is useful for decision making. Regulation also ensures that entities adopt similar treatment for similar items and account for similar transactions in the same way. Ensures similar treatment for similar items. And similar treatment of similar transactions. Similar treatment of similar transactions. Yes. So without regulation, entities will choose to treat transactions and items as they deem fit. But regulation here ensures that similar items are treated by all entities in a similar manner, and transactions are also treated in the same way everywhere. The third obvious reason for regulation is that it allows management to adopt whichever accounting treatment that presents its results and position in the best possible light. Management would adopt whichever accounting treatment best presents best presents results. So these are the need for regulation. Ensures external users are provided relevant and reliable information. Ensures similar treatment for similar items and similar treatment of similar transactions by all entities. And also ensures that management adopt whichever accounting treatment best presents their results. So these are the three reasons for regulation. What are the sources of regulation? Sources of regulation. The first is the accounting standards. Accounting standards. So these are authoritative statements of how particular types of transactions are reflected in the financial statements. The second, company law. And the third, listing rules of relevant stock exchanges. Listing rules of stock exchanges. So in our case in Ghana, we adopt the IASB standards, or we adopt the International Financial Reporting Standards, which is a source of regulation because if companies or entities are preparing their financial reports to meet the requirement of the IFRSs, then the IFRSs serve as a source of regulation. Company law. Our company law stipulates reporting requirements. So these stipulations made in the company law is a source of regulation because it will be adhered by companies. And then listing rules of stock exchanges. Stock exchanges have rules regarding the minimum information that should be provided in financial reports. So if entities are listed, by all means, they must abide by the stock exchanges rules regarding financial reporting. So these three come together as the source of regulation relevant or mentioned in our syllabus. Right. Let's look at the IFRS Foundation and the IASB. Right. The IFRS Foundation is a not-for-profit organization run by 22 trustees. Run by 22 trustees. Now, what is the responsibility of these trustees? Their responsibilities are they are responsible for the governance of the foundation, and the bodies within it, and they're also responsible for fundraising. So these 22 trustees, they're responsible for, in summary, two things. First, the governance of the foundation and the bodies within it, and then fundraising. Let's look at the constitution of the IFRS Foundation. The IFRS Foundation is made up of 6 trustees from Asia, 6 trustees from Europe, 6 trustees from the Americas, 1 trustee from Africa, and then 3 trustees to be appointed from any area. From anywhere. Right. So this is the constitution or the makeup of the IFRS Foundation. Now, within the IFRS Foundation, we have bodies. One of such bodies is the IASB. And the IASB is the International Accounting Standards Board. This board is the standard setting body of the IFRS Foundation. So the IASB is the standard setting body of the IFRS Foundation. The IASB is solely responsible for developing international accounting standards, and they also have the full responsibility for all IASB technical matters, including the issue of IFRS and revised IASs. What is the objectives of the IASB? The objectives of the IASB is to promote the use and application of the standards. Promote use and application of the accounting standards. That is one objective of the IASB. The next objective is to develop in the public interest a single set of highly quality global accounting standards. So develop high quality global accounting standards. And three, promote and facilitate the adoption of IFRS through the convergence of national accounting standards and the IASs. So, the third objective of the IASB, promote convergence of national accounting standards and the IASs. So, three objectives of the IASB. The first is to promote the use and application of the accounting standards, develop high quality global accounting standards. And the last one is to promote and facilitate the adoption of IFRSs through the convergence of national accounting standards and the IASs. Let's take a look at the constitution of the IASB. Constitution of the IASB. The IASB has 14 members. 14 members. Now, all these members are with very high level of technical expertise in accounting. They are appointed by the IFRS Foundation trustees for a 5-year term, which might be renewed once. So the IASB is made up of 14 members with very high level of technical expertise in accounting. Then they are first appointed by the IFRS Foundation trustees for a 5-year term, which might be renewed once. Now, each member has one vote. Then approval of 9 members is required for the publication of an exposure draft. So each member has 9 votes, has one vote. And then approval of 9 members is needed for an exposure draft. A revised IAS, an IFRS, and a final interpretation of IFRSIC. So, constitution of the IASB. The IASB has 14 members. Each member has one vote, and then approval of 9 is needed for an exposure draft, a revised IAS, and then a publication of an IFRS, and a final interpretation of IFRIC. We continue our discussion with some of the bodies in the IFRS Foundation. We have the IFRS, which is the International Financial Reporting Interpretations Committee. They have two roles. The first role of the IFRSIC is to interpret the international accounting standards. Interpret the accounting standards. And then their second role, issue timely guidance on issues not covered by the accounting standards. And then finally, three roles. And finally, publish draft interpretations for public comment. Draft interpretation for public comment. So these are the roles of the IFRS Interpretations Committee. First, they interpret accounting standards. The committee issues timely timely guidance on issues not covered by the standards, and then publish draft interpretations for public comment. Let's shift our attention to other bodies. The first of such bodies have the Global Preparers Forum. The GPF. The GPF is an independent body set up with the aim of providing the IASB with regular inputs from the international community of preparers of financial statements. They provide inputs into the concepts and proposals that the IASB is developing, and they offer advice to the IASB on the practical implications of its intended proposals for preparers of financial statements. So that is all about the Global Preparers Forum, an independent body made up of preparers of financial statements, and all they do is to provide the IAS with regular inputs regarding the concepts and proposals that the IASB is developing, and then offer advice to the IASB on the practical implications of its intended proposals for preparers of financial statements. Another body is the Financial Crisis Advisory Group. Financial Crisis Advisory Group. Financial Crisis Advisory Group. This group was formed at the request of the IASB and the US Financial Accounting Standards Board to consider reporting issues arising from the crisis in 2008. It is comprised of 15 to 20 senior leaders with broad experience of international financial markets. So they discuss potential areas that require the attention of the IASB in order to avoid future market disruption. And then they also discuss the need for a due process for accounting standard setters and its implications for resolving emergency issues on a timely and inclusive basis. So these are the other bodies in the IFRS Foundation. We shift our attention to the standard setting process. Before an IFRS is published, or before an accounting standard is published, what processes are followed by the IASB before an IFRS or accounting standard is published? We must note that the IFRSs are developed through the international due process. Now, the due process normally involves the following steps: standard setting process. Number one, a subject is identified as being appropriate for a new or revised standard. So, identification of a subject. Identification of a subject. That is the first step. So the IASB identifies a subject that it thinks is appropriate for the development of a new accounting standard or a revised accounting standard. Then, national accounting rules and practices are studied. National accounting rules and practices are studied. What is the purpose? They are studied to understand how such issues or the issue identified as a subject is dealt with at the national level, and there is also exchange of views with national standard setters. The third step is that an advisory group is established to give advice to the IASB. An advisory group, establishment of an advisory group and the purpose of the advisory group is to give an advice to the IASB regarding the subject matter. The fourth the fourth step, a discussion document is issued by the IASB for public comment. A discussion document is issued for public comment. So after the IASB has identified a subject, national accounting rules and practices are studied, and there's an exchange of views with national standard setters, an establishment of an advisory group to advise the IASB. Then the IASB issues a discussion document for public comment. So after receiving comments on the discussion document, the IASB issues an exposure draft. An exposure draft is issued by the IASB after receiving comments, and then all the comments on the exposure draft and discussion documents are considered. That is the sixth. Consideration of comments on the exposure draft. Exposure draft. And then finally, an approved IFRS is published, subject to the appropriate level of IASB approval. And finally, an approved IFRS is published. So these are the 7 processes involved in the standard setting process. First, an identification of a subject which the IASB deems fit to be considered for a new standard or a revised standard. When this issue or subject has been identified, national accounting rules and practices are studied, and there is an exchange of views between the IASB and national standard setters. There's then an establishment of an advisory group to advise the IASB concerning the subject matter, after which a discussion document is issued for public comment. After receipt of public comments, an exposure draft is issued by the IASB. Then there is consideration of comments on the exposure draft, and then finally an approved IFRS is published. Right. We continue with global harmonization of accounting standards. Global harmonization of accounting standards. This refers to the goal of establishing a single set of accounting standards that will be used by firms internationally. The belief is that this would lead to greater market efficiency through the quality of information and should make raising finance cheaper and easier. Now, two candidates of convergence is the US GAAP, which is used by firms in the US, United States. So the generally accepted accounting principles, and then the IFRS, which is made up of the IASs and then the IFRS. These are the candidates or the two groups of accounting standards that are being converged into a global standard. Now, what advantages do we stand to gain from such convergence? Advantages of convergence. Investors and analysts of financial statements can make better comparisons. So, better comparisons. That is one. Because if companies in Ghana, for example, are using the same accounting standards as companies in Nigeria, and it will be easier to compare their performances because both financial reports or statements have been prepared using the same rules, and as such, comparison will be made easier and better. The next, for international groups, harmonization will simplify the preparation of group accounts. Simplify preparation of group accounts. Simplify preparation of group accounts. A parent with subsidiaries in different countries can easily prepare consolidated financial statements because the separate financial statements of the subsidiaries have all been prepared using the same rules. So the parent putting all those financial statements together would find it very easy. So this is another advantage of harmonization. The third, if all entities use the same framework for financial reporting, management should find it easier to monitor performance within the group. So this refers to, or it applies more to groups, easy monitoring of firms in the group, right? Convergence may also encourage growth in cross-border trading because entities will find it easier to assess the financial position of customers and suppliers in other countries. Self-explanatory. So convergence will encourage cross-border trading. Good. And then finally, access to international finance should be easier. Why? Because banks and investors in international financial markets will find it easier to understand the financial information presented to them by entities who wish to raise funds. We'll capture that as easier access, you know, easier access to international finance. Okay, so these are the advantages of convergence: better comparison of performance, simplify the preparation of group accounts. Convergence will help management monitor firms within the group. Convergence will encourage cross-border trading, and then it is easier to access international finance because financial investors or investors in international markets will find it easier to understand the financial information presented to them by entities who wish to raise funds. Let's look at some disadvantages of global harmonization or convergence of accounting standards. Disadvantages. Disadvantages. 1. National legal requirements may conflict. Conflict with national legal requirements. Legal requirements. So national legal requirements may conflict with the requirements of IFRS. Consequently, laws may need to be rewritten to permit the accounting policies adopted by IFRS. That is the first disadvantage. Two, cultural differences across the world may mean that one set of accounting standards will not be flexible enough to meet the needs of all users. So, lack of flexibility to meet the needs of all users. And then finally, some countries may feel or believe that their framework is satisfactory or even superior to the IFRS. So some countries may feel their national framework is superior to the IFRS. And this may create problems for international convergence. So the disadvantages of the convergence may be that conflict with national legal requirements. The requirements of the IFRS may conflict with national legal requirements, such as requirements in the company law of certain countries. And there may be lack of flexibility to meet the needs of all users because of cultural differences in countries around the world. And then some countries may feel their national framework is superior to the IFRSs. Right. Our next discussion is on financial reporting and corporate governance. Financial reporting and corporate governance. Financial reporting and corporate governance. What is corporate governance? Corporate governance is a system by which companies are directed and controlled. Now, how relevant is financial reporting to corporate governance? So, direction and control of companies or firms. Okay. How relevant is financial reporting to corporate governance? Financial reporting is a central issue to corporate governance because financial reporting is the means by which those charged with governance report the results of that governance to the owners and other users of the organization. So, corporate governance deals with direction and control of companies. And because of the separation of ownership from control, those charged with governance report the results of their activities to the owners and other users of the organization. Now, financial reporting is the means by which this is achieved. So, financial reporting plays a critical role in corporate governance to ensure that those charged with governance report well to the shareholders and that the company achieves its intended purpose and aims. Okay, now let's look at the codes or major codes of corporate governance. Major codes of corporate governance. The OECD principles, that is the first one. OECD principles of corporate governance. And then the next is the ICGN statement on global corporate governance principles. ICGN statement on global corporate governance principles. First, let's discuss the OECD principles of corporate governance. It is published by the Organization for Economic Cooperation and Development. That is what OECD stands for, Organization for Economic Cooperation and Development. Now, the principles published by the OECD is intended to assist governments of countries to improve the legal, regulatory, and institutional framework for corporate reporting in their countries, and then provide guidance for stock exchange investors and companies on how to implement best practices in corporate governance. Two purposes. First, assist countries to improve the legal, regulatory, and institutional framework for corporate governance, and then provide guidance for stock exchange investors and companies on how to implement best practices in corporate governance. That is all about the OECD principles for corporate governance. We shift our attention to the second major code of corporate governance, is the ICGN statement on global corporate governance principles. Now, the ICGN is the International Corporate Governance Network, and they have published some principles which aims to improve corporate governance practices around the world in all countries where institutional investors seek to invest. Now we must note that these ICGM principles are consistent with the OECD principles. However, the ICGM principles have more specific objectives for providing information to stock markets and companies around the world about issues investors will take into account in deciding how and where to invest. Now, an important objective of the ICGM principles is to remove bad corporate governance practices in countries where they still exist. Now, we also have the combined code, which is the third major code, combined code. Now, this was published in the UK. Now, the combined code covers many aspects of corporate governance, including the role of directors, chairman, and non-executive directors, effectiveness of the board, strategy and governance, remuneration of senior executives, accountability, corporate ethics, and then social responsibility. So these are major codes of corporate governance. Right. We continue by looking at the role of financial reporting in corporate governance issues. We must remember that the reports and accounts allow shareholders to assess whether the companies have been governed in the interest of shareholders. Okay? And then shareholders can do this if financial statements are reliable. And we must also remember the reliability of financial statements depends on some few things. Let's quickly look at them. Reliability of financial statements depend on the quality of the accounting rules. That is one. The honesty of the company. The honesty of the company. Next, the choice of accounting policies. 4, the care used by directors to satisfy themselves that the accounting provides a true and fair view and that all relevant issues are provided. The care used by directors in ensuring a true and fair view. And then finally, the opinion of the external auditors. Now, the opinion of the external auditors should be the opinion of independent professionals. So these are the roles that financial reports play in corporate governance. What are the prerequisites of good quality financial reporting? Prerequisites of good quality financial reporting. Now, to make boards properly accountable of high standards of financial reporting and external auditing. To make boards properly accountable, high standards of financial reporting and external auditing must be upheld. Now, this requires that there is a high quality set of accounting rules, high quality set of accounting rules. This is the first prerequisite of good quality financial reporting. High quality set of accounting rules. 2, mechanisms to ensure compliance with those rules. Mechanisms to ensure compliance with those rules, and then proper application of the rules. So these are the prerequisites of good quality financial reporting. First, there must be high quality set of accounting rules. Then, mechanism to ensure compliance with those rules, and then the proper application of the rules. We must note that with accounting standards, it is important if the financial statements fairly represent the activities of the entity. If this is the case, companies will benefit from more investments to increase their profits, and the national economies will benefit from having strong and profitable companies. So financial reporting benefits, or let me say good quality financial reporting benefits the entity or the company and then the economy as well. We will end our discussion with the IFAC Code of Ethics. IFAC Code of Ethics. The IFAC Code of Ethics. Accountants who are responsible for the preparation of financial information must ensure that the information is technically correct, reports the substance of the transaction, and is adequately disclosed. We must note that ethics starts with the individual preparing the information. The IFAC published the Handbook of the International Code of Ethics for Professional Accountants. ICAG, which is the Institute of Chartered Accountants Ghana, subscribes to this code. One of the main roles of the code is to provide guidance in ethical dilemma situations. Let's look at the fundamental principles of the IFAC Code of Ethics. There are five fundamental principles. The first, integrity. The second, objectivity. The third, professional competence and due care. Four, confidentiality. And then five, professional behavior. These are the five fundamental principles. We discussed them briefly. Integrity. Integrity means that professional accountants should be straightforward and honest in all professional and business relationships. It also implies fair dealings and faithfulness. So, keywords to note from integrity: straightforward, straightforward, and honest, and then fair dealings and truthfulness. So, integrity implies that professional accountants should be straightforward and honest, should deal fairly, and be truthful in all professional and business dealings. Objectivity means that professional accountants should not allow bias, conflict of interest, or undue influence of others to override their professional or business judgment. Keywords to note: we should not allow bias, conflict of interest, or undue influence to cloud or override professional or business judgments. Keywords to note: bias, conflict of interest, undue influence. Now, professional competence and due care means that professional accountants have a duty to attain and maintain their professional knowledge and skill at such a level that a client or employer receives a competent service based on current developments in practice, legislation, and technique. So, maintain. The keyword is to maintain professional knowledge. Professional knowledge at a level such that clients will receive competent service. It also means that acting diligently in accordance with applicable technical and professional standards. Acting diligently in accordance with technical and professional standards. Confidentiality. Professional accountants must respect the confidentiality of information acquired as a result of professional and business relationships and should not disclose such information to third parties without authority or unless there is a legal and professional right or duty to disclose. That is all for confidentiality. Don't disclose info to third parties. However, in situations where the professional accountants have obtained authority to disclose, or there is a legal or professional right or duty to disclose, then the professional accountant should disclose information. In such a situation, there wouldn't be any breach of confidentiality. We end with professional behavior. What does this mean? Professional accountants must comply with relevant laws and regulations and should avoid any action which discredits the profession. Complying with laws and regulation. That is one. And then two, avoiding actions which discredits the profession. Avoiding actions which discredits the profession. Right. This is all about the fundamental principles contained in the IFAC Code of Ethics. Integrity, being straightforward, honest in all business dealings, and then being truthful. Objectivity, not allowing bias, conflict of interest, or undue influence to override professional judgment. Professional competence and due care, maintaining professional knowledge at a level which allows the professional accountant to provide competent service to clients and employers, and then acting diligently. Confidentiality, not disclosing any information obtained as a result of the professional relationship to third parties. However, professional accountants may disclose such information where they've obtained authority or there is legal or professional duty to disclose. Then finally, professional behavior, complying with laws and regulation, and then avoiding actions which discredits the profession. Threats to the fundamental principles. Threats to the fundamental principles. We have five of such threats. The first is self-interest threat. Self-interest threat. Two, self-review threat. Three, advocacy threat. Four, familiarity threat. And then five, intimidation threat. Let's do a brief discussion. Self-interest threat. Self-interest threat may occur as a result of the financial or other interest of the professional accountant or their immediate or close family members. As such, the professional accountant may be reluctant to take actions which would go against their interest. And the interest the professional accountant may be financial, incentives, compensation, and then inappropriate use of corporate assets. So, because of the self interest of the professional accountant or their immediate close family members, the professional accountant may be reluctant to take actions that would go against their interest. Such situation or such threat is a self interest threat. An example of such may be financial interest, loans, guarantees, incentives, compensation packages, or inappropriate use of corporate assets. That is, using corporate assets for the personal gain of the professional accountant. Self review threat occurs when a previous judgment needs to be re-evaluated by professional accountants responsible for that judgment. A professional accountant has made a decision or has applied their professional competence in making a judgment, and that same person is responsible for re-evaluating the decision made. Such a situation will lead to a self-review threat. Advocacy threat is the third. It happens when a professional accountant may promote the organization's position by providing financial information as long as the information provided is neither false nor misleading. Such actions would not create an advocacy threat. So, for example, the entity needs a loan from a financial institution, and the professional accountant provides certain information that promotes the position of the of the entity, knowing very well that such information is false. In such a situation, there is an advocacy threat. However, as long as the information provided is neither false nor misleading, such actions would not create an advocacy threat. So, advocacy threat arises normally when the information provided to promote the interest of the client is false. We move on with familiarity threat. It occurs when, because of a close relationship or professional accountant becomes too sympathetic to the interests of clients or others. It occurs when, because of a close relationship, professional accountants become too sympathetic to the interests of others. So, for example, a financial accountant has been in service of an entity as an auditor for so long, and because of that, the auditor thinks that, oh, everything is well. So the auditor overlooks certain things because one, the auditor is sympathetic, or the auditor trusts the entity so much. Such situations will lead to familiarity threat. And the final threat to the fundamental principle is the intimidation threat. As the name suggests, it occurs when a professional accountant conducts is influenced by fear. Example, threats of dismissal or replacement, threat of dismissal, replacement, or A dominant individual attempting to influence sorry, the decisions of the professional accountant. Dominant individual influencing the decision of a professional accountant. In such a situation, the professional accountant may feel intimidated and as a result may not act objectively because of fear when one is threatened of dismissal or replacement, or a dominant individual attempts to influence the decisions of the professional accountant. It amounts to intimidation, threat. Right, so this brings us to the end of our discussion on the regulatory framework. We've looked at the need for regulation, the IFRS Foundation and the IASB, together with other bodies in the IFRS Foundation. We've discussed the harmonization of accounting standards. We've looked at financial reporting and corporate governance, and we ended with the IFAC Code of Ethics. Right. So thanks for joining us. Thanks for watching. In our next video, we will discuss the conceptual framework for financial reporting. See you in our next videos. Please subscribe, like,